Hello, everyone, and welcome to our monthly webinar. My name is Justin Cooper. I am a hard money lender and full-time real estate investor. Each month, we bring in some of our friends in the industry to share their expertise. This may be through a presentation, like when we talk about self-directed IRAs or title insurance, or we may simply interview our expert friends and dive deep into how they got started, where their investing has taken them, and what they see coming both for themselves and for the industry. Now, I want to say thank you to everyone who made it to tonight's event. We know that you're giving up some of your time, and so Peter and I will do everything we can to bring you the value that you're hoping for. This webinar is brought to you by Pine Financial Group. Pine Financial is Colorado, Minnesota, and Wisconsin's premier hard money lender. Pine focuses on the needs of real estate investors, and we are investors ourselves, and we know what it takes to get deals closed. Everyone at Pine Financial Group is dedicated to the success of its clients. We only experience success when our clients are succeeding. So we have a habit of telling you when a deal should or should not be done. And isn't that what you want from a professional in the industry, especially someone that you trust as an advisor? You will benefit from our honesty and integrity when you choose to work with us. Now, if you're in Colorado, our Real Estate Investor Success Summit is coming up on Saturday, October 20th. This is the premier real estate investor event. We are expecting between 300 and 500 attendees. We'll have 8 local experts and investors speakers. We've got 20 vendors lined up and an expert panel, and of course, the networking happy hour at the end of the day. The best part, there will be absolutely 0 sales pitches. If you've not yet registered, please go to denveriss.com to register. Again, that's www.denveriss, like Investor Success Summit, denveriss.com to register. Now, tonight's webinar brings in a longtime friend and attorney, Peter McFarland. Peter practices in the field of tax law because he wanted to stand at the intersection of life's most important events and help clients navigate through them. Peter earned both his Juris Doctorate and Masters of Laws in Taxation from the University of Denver. He has successfully counseled clients through tax litigation, estate planning, business entity formation, and is a recognized authority on asset protection. He also regularly speaks to business associations, investors, and other attorneys on the complexities of tax law. Peter, can you go ahead and tell us a little bit more about yourself before we dive into tonight's presentation?
Yeah, absolutely, Justin. And before I do that, I want to give a shout out to Pine in general, but really Justin in particular. Anybody who's worked with Pine and really Justin in particular knows really how great they are and what a wonderful organization, and just kind of the way that you guys go above and beyond is really unparalleled. I've been really impressed, and my clients have had such a good experience with you. So I just want to give a shout out to that, as well as the Success Summit. Everybody, if you've never been to the Success Summit for Pine, you really should go. It's really a unique experience. I have met a lot of good connections at the Success Summit over the years, and I would highly consider going if you've never been. I'm actually going to skip a little bit forward. Justin, you asked a little bit more about me, and I happen to have this I love me slide. And so I'll just go ahead and just segue right into this. So as Justin mentioned, I went to the University of Denver, got my law degree, went back. My family thought I was nuts, but I went back and I finished out another degree that only focused on the tax code, and I can tell you it's about as exciting as you would think it would be. But I love how tax touches everything, and that's kind of what Justin was saying in my introduction there. Being able to stand at the intersection of so many different things. I have clients who are setting up nonprofit organizations, right? They're buying their first house, they're funding their children's education, right? And tax has something to do with all of that, and I love seeing where we can propel people and just be smart with their money and not pay any more in taxes than we really need to, right? After being at the University of Denver there, I was able to go to Long Law Group, and I got my job there as the associate attorney. And, I there have counseled clients on a range of matters, but, what I really love actually, and what I've fallen into as almost my side hobby, is talking in front of other groups and getting information out there. And I love writing in the Colorado Real Estate Journal, which you can see a few of my articles there over to the right. This picture, by the way, was taken clear back in 2013. I still look very young, but I don't look like I'm 12 anymore. But I put that picture in there because that personally makes me kind of crack up. I'm going to do, there's going to be some upcoming collaboration that I'm going to do, and I'm going to actually start doing some in-person speaking monthly. And if you're interested in what I'm talking about tonight and kind of interested in learning more about law in general, tax in general, and really specifically geared towards real estate, you might contact our firm and get on our mailing list because we're going to start doing these monthly presentations. I'm going to collaborate with other people and kind of bring in, some new thoughts and perspectives that maybe even my own clients haven't really been exposed to. So more word on that. I'm keeping it a little close to my chest at the moment, but we're going to get started here next month, October. And join our mailing list to find out more. And you can always check out our website to find out what else is going on. It's listed there, longlg.com. So that's just the real quick introduction to who I am. Justin, should I give it back over to you, or should I just go ahead and go here?
No, you're doing great. I want you to keep going. But just a quick note through the webinar, if you guys have questions, and we really hope that everyone on the call does, please use the questions section. So I'll be monitoring that, and I'll be cutting off Peter every chance I get with any of your questions. So now we are trying to keep this presentation a little high level. So if you have a very nuanced, very specific question, it might be a little harder to answer on the call tonight because Peter may need a little bit more information for your specific situation. So in that case, it might be best to just reach out to him directly after the webinar. But if you have questions, feel free and just ask. And again, if Peter needs more information or to take this maybe offline, then we can certainly do that. But please jump into the questions section and ask away tonight.
Yeah, absolutely. And further to that point, I actually like, and Justin, I hope you cut me off quite often, actually. I like when the webinar almost turns into more of a discussion than it does me just going through the slides and talking to a wall. So certainly ask your questions. And then if things are a little more involved, one of two things might happen. I may either decide that we'll kick it to the very end because I do have that question and answers section. And so if it's a little more involved, maybe I can address it there. That way other people, they can get off the call if they need to. But if it is super, super involved, then yeah, we're probably going to want to talk outside the context of the webinar here. So really good point there, Justin. I'm just going to go ahead and get started on really everything. Just so you guys know, I picked a very ambitious kind of topic tonight. I didn't really know how everything would come together until I created my slide deck, and I was looking at my slide deck about an hour before this presentation, and I realized there's more information here than really I can present in an hour. And so I'm going to do the best that I can to cover, the most important points here. And luckily, the very last topic, which was accelerating passive losses, that's really not a whole lot of new information. And so even if that part gets cut out for time considerations, I don't think that we're going to miss out too much. But at any rate, my topic tonight was entity choice after the Tax Cuts and Job Act. And I'm terribly excited this year, and the reason is because we actually have new information to talk about. As a tax attorney, as an asset protection attorney, there's not necessarily a whole lot of developments that happen very quickly that allow me to be very excited. The tax code in general was written in 1986, and we really haven't had much of an update until now. And you can see, for there to actually be something new to talk about since 1986, a lot of us in the profession are actually very excited. And so the more that I can get out there, the more I can get this information out there, I think the better my clients and all of you are going to be served. But aside from that, it's actually fun for me to talk about because I have something new to talk about. So what I'm going to do is I'm going to walk you through kind of the best practices for asset protection structuring, talk about a new deduction that's available, the 199A deduction, and how the entity that you choose may actually play into and maybe even benefit you more with that new deduction. There's self-employment tax strategies. So if you're working for yourself, we'll talk about ways to reduce your tax bill there. And then if we have time, we'll talk about the passive losses. I'm doubting we're going to have time, but we'll see where we get. And we will have a dedicated question and answer section. So, we can always address questions then. If you've ever seen me talk before or been on a webinar with me, you know I like to use these roadmap slides. And, you know, I recognize that sometimes tax law is not the most interesting thing, particularly if you're doing this as a webinar. You may go off and, you know, go on to a different web page or something. Please don't do that. But if you do, you know, you can come back, and if you see this roadmap slide, which shows up often in my presentation, it'll help you recenter on what I'm going to talk about and where I am kind of in the flow of the whole thing. So without further ado, let's just go ahead and get started here. So opening perspective, if you Google Army of Lawyers, there's not always a whole lot of charitable pictures. This is probably the most charitable picture to my profession that I could find. But you know, why, the question that I want to address is, why do we want to even set up a business entity, right? This study, unfortunately, it's dated. I wish I could find more updated data, but a study looked at all tort claims for the period of 2008 to 2012, right? Tort claims, for those of you who did not go to law school or are unfamiliar with this, tort claims are basically personal injury claims, right? They're the type of claims that a tenant might bring against a landlord, right? Or maybe a contractor might bring against a rehab company if somehow the rehab company's negligence, you know, kind of contributed to them hurting themselves, right? So in this period, this 2008 to 2012 period, 15 million civil cases were filed for tort claims, okay? That's big business. That's a lot of cases, right? 251 billion with a B was spent by Americans just on civil litigation. So once again, it's very big business. A lot of people are interested. A lot of lawyers are interested. And you've seen these signs that say, what is my case worth, right? Free intake, you know, let's take a look. Does it actually make sense to sue? And a lot of times with these kind of free intakes and the low barrier to setting a court case in motion, you'll wind up with frivolous lawsuits, right? One of my favorite examples, all-time favorite examples, was, if you recall, a few years back, there was a Budweiser commercial where the guy was sitting at the bar, he cracks open a beer, all these pretty ladies show up and they all kind of get around him and everything. And anyways, he went to a bar, cracked open his beer, and no pretty ladies came, nobody surrounded him like in that ad, and he said that that was false advertising. Right. Now, whether there's any merit to that, that's a whole nother discussion, but this was a real lawsuit that was filed, and Budweiser had to defend against it, right? They had to figure out what they were going to do with that. Another really good one is the clapper. We all remember the clapper. You know, there's a great old ad where an old lady laying in bed, you know, kind of claps her hands, the lights turn off, I guess, for those of us who are younger and don't know what a clapper is. But at any rate, this person clapped their hands and actually injured themselves somehow clapping their hands, and they sued the clapper, saying that, you know, the clapper was responsible for their injury. Again, you know, whether there's any merit to that or not, that's debatable, but this was a real lawsuit filed in a court, and the company that made the clapper had to deal with this, had to figure out what they're going to do. And so a lot of times what happens with these frivolous lawsuits, or really even lawsuits that are meritorious, is that they become, they settle, right? And so $1.6 billion, that's B billion, was spent in 2010 just settling these lawsuits, just making them go away. And so once again, this is big business, right? I think this personally is the very scary. Plaintiffs, which are the people who start the lawsuit, the people who typically are the injured, they win 55% of the time. And so statistics says it's a better than half chance that you're going to win, right? 80% of the world's lawyers live in the United States. I'm one of them, unfortunately for all of us. There's about one new lawsuit every 2 seconds and about one new lawsuit for every 12 adults, right? So it's big business. It happens. People get sued. Let's talk about Colorado. Just looking at the numbers, it is coming down. I could have updated this slide, I didn't have time, but you can see about 1,000 new attorneys pass the bar every single year. Now, granted, there's drop off. There's some who retire, some who are disbarred, some who retire or give up or, you know, take a different job. But, you know, 1,000 new faces coming in every single year, and all of them want to make their name. And actually, that's a picture of my graduating class over there. I'm in that group somewhere. But at any rate, why do I bring this up, right? And the reason I bring this up is that a lot of people, and particularly those with assets like real estate investors, are walking around with a target on their back. And there's a lot of potential attorneys out there who would take a case and see if it's worth pursuing, right? Seeing if nothing else, if they could get a settlement. So, that's not necessarily a fun topic to start out with, but at the same time, it's a cautionary tale to say that we need to structure, and we need to structure correctly, because we need to make sure that you have barriers in place to make it harder for potential creditors or potential people who may sue you, plaintiffs, to sue you and successfully reach your assets, right? So let's talk a little bit about timing. When we do asset protection planning, when we look at setting up an entity, we need to be proactive. We don't want to be reactive. The reason is there's a whole theory in law called fraudulent transfers. And basically it talks about the timing of asset protection. And the whole point is that you cannot structure after something happens, because that's considered a fraudulent transfer, and they'll actually unwind the structuring that you're doing and make the individual who's hurt whole. So just a real quick example of how this works, and this is based on a real example that happened to me, and I had a really fun day in the conference room when I had this intake. And fun is used very loosely, right? It was actually a really awful discussion, but Larry Landlord has $600,000 in rental property. All of it's titled in his personal name. What Larry Landlord at the time did not tell me is that his tenant was injured when we were looking at doing the structuring. So he comes in to set up some LLCs. We set up the LLCs. And then his tenant sues him. Well, what do we tell Larry? Unfortunately, we tell him that all those LLCs that we set up, all of the structuring that we did, is not going to provide him protection. And the reason is because of those fraudulent transfer rules. Now, if Larry Landlord had come in a week before his tenant had injured themselves and we were able to successfully structure everything, get the titles transferred, everything else, he would have benefited from the LLC protection, right? And so timing is critical when it comes to this asset protection structuring. It needs to be done beforehand and not after potential harm and a potential lawsuit. So that's getting past my opening perspective there. Next I'm going to talk about the best practices for asset protection structuring. Justin, I'm just going to real quick ask if there's any questions or anything that I might want to address.
Yeah, actually, we do have a question.
Okay.
So this person says, I understand that the new tax law allows for accelerated depreciation for capital improvements. Are we also allowed to accelerate improvements which are already on a schedule from previous years?
That's a very good question. And yeah, I'm not going to talk about that in this particular webinar. And the reason is because we're getting more into specific new provisions about the Tax Cuts and Jobs Act versus how the Tax Cuts and Jobs Act impacts business entities, right? And so, we should certainly feel free to ask these questions. We can address them in the Q&A session at the very end if there's time, because there is a lot of new provisions in the Tax Cuts and Jobs Act, and a lot of them potentially really do benefit real estate investors. And I could really do, and I do actually have an entire presentation just discussing the new tax law and the changes. To more directly answer your question, yes, you should be able to reclassify the method of depreciation that you're using. But what I would recommend doing is if you're really going to go through the effort of looking at doing that, you should consider a cost segregation study. And the reason is the cost segregation study is going to actually allocate certain amounts of the price that you've paid for the property into different depreciable classes with different recovery lives. And so if the default, say, is to depreciate a piece of an investment over 27 and a half years, rather than depreciating the entire asset over 27 and a half years, let's see if we can allocate some of the purchase price to 5-year property, to 10-year property, to 15-year property, and recover those bits even quicker. And then whatever doesn't qualify for that accelerated depreciation just based on its class or its life, then we'll look at using we'll look at using accelerated depreciation in the first place anyways. But anything else that doesn't qualify for accelerated depreciation, we might be able to move into a class that recovers quicker. So I bungled that a little bit. Hopefully that makes sense. If you have more questions on that, of course, we can discuss it. But real targeted directed questions about the Tax Cuts and Jobs Act, let's save to the question and answer section, just so I can actually talk about some of the more pointed issues with the business entities. But that's a great question.
That's all we got for now, so let's keep going.
All right, perfect. Thank you, Justin. So best practices for asset protection structuring. There's a lot of different business entities that you might consider talking about or setting up. There's C corporations, S corporations, general partnerships, limited liability, limited partnerships, LLCs. There's any number that we could look at setting up. And which one you're going to want to set up is going to depend a lot on really what your goals are, right? If you're really trying to maximize your medical benefits, for instance, we might consider integrating like a C corporation into your structure. If you're looking for the maximum asset protection, we're probably going to look at an LLC, maybe a limited partnership. We might look at whether you have passive or active income. Is the business eventually going to go public? There's a lot that could go into kind of the triage of choosing which business entity is correct for you. That said, most of the time I end up setting up an LLC, and that's more or less the entity of choice of me, but not only me, really a lot of professionals. As you drive down the street, and this is just a thought experiment, you might try this. As you drive down the street and you look at all of the different businesses and you look at all of the different professional offices and things like that, just look at the company indicator that follows the name, right? I think most of the time you'll find that they're an LLC. Occasionally you will see, I think, an LP, and then you'll see INC, which is corporations, right? Corporations, I think, by and large, are falling out of favor because they're so rigid, but all the same, tonight I'm really going to focus just on LLCs, more or less just because of time constraints. I could actually do an entire presentation just on all the different entity types and why you might choose one over the other, but that's not really what I'm here to do tonight. So the advantages real quick of a limited liability company and why that is really my go-to is it gives great personal liability protection. There's limited risk of investment loss. Losses, if it's set up to be taxed correctly, can actually offset other income that you might have. A lot of people refer to the LLC as a hybrid between a corporation and a partnership, and it really is true. And it has a lot of the protections that a corporation traditionally would enjoy, which are very powerful and very strong. And then a lot of the flexibility of a partnership that a corporation just doesn't have. And so in a lot of ways, it's really the best of both worlds between a corporation and a partnership. There's flexible memberships. Individuals can be owners, trusts can be owners, other business entities can be owners. That's not true of, say, an S corporation, right? You'll terminate the S election if you have somebody who's kind of a not allowed member, right? They're easy to operate. That's kind of what I was talking about the flexibility of the partnership. There's less formality that goes into how you have to run them. And finally, you can elect the taxation. There's flexibility there. You can elect how you want that LLC to be taxed. When I say that you can elect the taxation, what does that mean? Basically, the tax code, it was written in 1986, and LLCs showed up in about 1991 or 1992. When LLCs showed up, Congress didn't rewrite the tax code, right? Instead, they kind of gave like a statute that kind of kicked the responsibility to the IRS and the Treasury Department. And the Treasury Department basically said, look, when you set up an LLC, just tell us in the existing 1986 categories how you want it to be taxed. And so what that means is that you can see from my infographic here, you have a corporation. If you set up a corporation, you can only be an S corporation or you can only be a C corporation. Those are your only two options, right? But with an LLC, it's way different. You can actually be a disregarded entity, which just means that the LLC, it's like it doesn't exist. You just file like a sole proprietor on Schedule C, Schedule E, Schedule F, whatever it may be. You could be a partnership, file the Form 1065. You can be an S corporation, file the Form 1120S, or you can be a C corporation. You can file Form 1120. And so, and even within that, the LLC could be a partnership 1 year and then elect to be an S corporation the following year, right? And so there's a lot of flexibility in how we might have that LLC taxed. And it's that flexibility kind of coupled with the less formality that an LLC has that really makes it the entity of choice. And so tonight, like I said, I'm really only going to talk about LLCs because it's really kind of the standard and kind of the go-to. But if I talk about an LLC or I start talking about an S corporation, realize that actually a lot of times those can be used interchangeably, right? If I start talking about the savings that an S corporation can generate for you, well, an LLC taxed as an S corporation is going to do the exact same thing, right? Because an LLC taxed as an S corporation, as far as the IRS is concerned, they just treat it like an S corporation. So hopefully that makes sense. I haven't lost anybody on that one. Now, a lot of you may have heard about single member LLCs in Colorado, and maybe they're not the best, maybe they don't have any protection. I'm hoping at least, if I were doing this in person, that some people would be raising their hands and saying, oh yeah, I've heard that. I'm going to talk a little bit about this court case because I was guilty. I was one of these practitioners that used to say, oh, single member LLCs, they're just not really worth it here in Colorado. But then I really thought about it, and I really took a very wary eye to the ruling. And I've come out a little bit different, and I think with maybe a little more of a mature reading of this case than a lot of other practitioners have. And so I'm going to kind of explain this. So there was a bankruptcy ruling here in Colorado. And basically, it was in Ray Ashley Albright. 2003 was when the case came out. In the United States Bankruptcy Court, District of Colorado. If you really want to find it, I'm sure Google would pull up that case. I can't recommend reading it. These cases are typically not, just edge of your seat kind of reading. But of course, you're welcome to. But in this case, it was a single member LLC, and it owned real estate, right? The single member of the LLC declared bankruptcy. And the argument was, well, can the judge pierce through the single member LLC and force that single member LLC to sell its real estate holdings to make the bankruptcy creditors whole? And when the judge thought about this and kind of went through the analysis, what the judge said in essence is that because there's only one member in the LLC, there's no non-debtor members to protect. Right. And so because there's no kind of innocent party, so to speak, there's no reason to maintain the LLC and not force it to sell its holdings to make the creditors whole. And so that's exactly what they did. They pierced through the LLC to sell the holdings of the LLC and make the single member their creditors whole. And so that's a very troubling ruling for us here in Colorado for asset protection reasons. Because on its face, it looks like a single, it's done. There's nothing else to talk about. A single member LLC is not going to provide protection, right? So is that really what this case stands for?
Hey,
the answer is maybe, right? You have a Colorado statute, and that's the one that I've written here, that basically just says, look, a party that seeks to, more or less what we're going to do is we're going to use corporations, corporate case law, to apply it to the LLC and determine whether the individual is going to receive asset protection, right? And so if you apply corporate case law, actually, I think the LLC should receive asset protection. And so you have a Colorado statute saying more or less different from what this bankruptcy court is saying. And then the other kind of wrinkle in this is that you have a federal court interpreting state law, which there's a difference of opinion there. And so the two pictures I have here, on the left, you have the Colorado Supreme Court. On the right, you have the US Supreme Court. What we need is a ruling from one of these two courts that says which law is actually going to apply, right? Because we kind of have an open question. One statute that says, okay, these are actually going to have limited liability, and then a bankruptcy ruling saying that it's not going to, right? The other thing is that this case is limited to the bankruptcy context. We're not talking about potential creditors who hurt themselves on a property. We're talking about somebody who declared bankruptcy, right? And so there's a limitation there as well. In addition to that, This case is what's called reverse veil piercing. I don't want you to get too wrapped up in this because I think this is just kind of stupid and it has a lot of different graphics here to kind of illustrate a very simple point, which is that basically what we have is the harm. They're suing the LLC owner. It's this bottom graphic here, the reverse veil piercing, where the harm, they're selling the LLC owner and then they're piercing through the LLC to get to LLC assets, right? That's probably not going to be the traditional kind of way that your exposure is going to find you, right? Probably your tenant or whoever is going to sue your LLC, right? And then your LLC, they're going to try to pierce through, get through you as the owner and get to your personal assets. That's the traditional veil piercing. So all that we know from Albright is that it's a bankruptcy case that maybe, limited to the bankruptcy context, that has a difference of opinion from a Colorado statute. And we need a Supreme Court case ruling that is going to clarify the kind of the difference of opinion and what the law actually says. And then in addition to that, we need to, the only circumstance potentially where this case is going to apply is where you have declared bankruptcy and or they're trying to do that reverse veil piercing. So it's limited in its scope, and I'm getting very technical, I think, here. I'm probably losing some people, but all the same, I think what most practitioners here in Colorado say is that a single member LLC is not worth it in Colorado. It doesn't have any protection associated with it. And I don't think that that's true. I think that there's a way to read it and a way to kind of thread the needle through the eye of the needle, the thread through the eye of the needle there, to say that single member LLCs are actually going to have protection associated with them. At any rate, all of that said, why be the test case, right? As much as I would love to be one of my heroes here, Dr. Everett Brown, I'd love to be him and be kind of, the scientist doing the test case. But I would never advise one of my clients at the end of the day to be that test case, right? Let's try if we can to stay out of that potential battleground, right?
Hey, Peter.
Yeah.
Got a question. Going back to the different types of entities, someone says, what do you mean when you say that LLCs are easier to manage? Less formality, and how so?
Yeah, that's a really great question. So there's a statute in Colorado that basically says that the failure of an LLC member to observe more or less traditional corporate formalities is not reason by itself to pierce through and reach assets of the LLC member. And so what that means is, like in the case of a corporation, there's a lot of formality that goes with the corporation. You have shareholders, you have directors, you have a board of directors, you have officers, a president, a vice president, a treasurer, then you have your board of directors, and then you have your shareholders. There needs to be meetings of all of these individuals, right? And this is established by hundreds of years of case law, that these are the kinds of requirements that must be met for asset protection to be given to the corporation. And so in a small corporation, maybe owned by a husband and wife, it's very silly to have three different meetings, right? One of the shareholders, which is the husband and wife, one of the board of directors, which is the husband and wife, and one of the officers, which is the husband and wife. Keep meeting minutes of all three of those meetings, right? And then come up with corporate resolutions for the actions of the company and show that actually, the corporate action has been voted on and approved by the proper parties within the corporation. All of that's very onerous, right? And the chances of people doing that is extremely remote, to say the least. So corporations have quite a bit of formality associated with them, right? What the statute says is, okay, if you don't follow those formalities, that's not a reason by itself to pierce through an LLC and reach the corporate or the LLC assets, right? And so LLCs can actually be run much more lax, much more loosely, right? Because those requirements just by themselves aren't going to be enough to pierce through. Now, that said, before everybody just throws all of their LLC formalities out the window and says, oh, Peter said that we didn't need to do any of this, that's not what I'm saying. I mean, you still should observe formalities, and you should still identify some that you want to have. I still advise all of my clients to have annual meetings, right? If nothing else, just sit down and look at the prior year financials and review them in the company minutes and just say, look, what did we spend on advertising last year? Can we pare that down 20%? Is rent still, is it still competitive for the area that it's in? Okay, let's raise it 10%, right? All of that looks very good. You can imagine with an LLC, two different scenarios where your asset protection comes under fire. Let's say that you go in to the courtroom and you say, okay, Judge, I paid my $50 to the Secretary of State. Here's my articles of organization, and I have nothing else. I think I should be protected, right? That doesn't look very good. It's probably not going to go very far, right? On the other hand, if you walk in and you say, okay, Judge, here's my articles of organization, here's my operating agreement. In my operating agreement, I say that I'm going to have an annual meeting. Here's 10 years of annual meeting minutes, right? I have a separate EIN. I filed my tax return every year. I have a separate bank account. It's a business bank account. It's not commingled at all with my personal funds. Right, all of that looks really good, and it kind of puts wind into the sails of the argument that that's actually a separate and distinct legal entity from you, and that's what's going to receive the protection. So even though the statute says that we can run those LLCs a little more loosely, we still want to have a core of formality to it, because if we don't, we're really going to run into trouble when we're trying to make the arguments in the courtroom. So hopefully that explains that. It's like the corporation is very locked in. You really have to observe those formalities, and there's a lot of them, and potentially failing to do any of them could be an Achilles heel to you. Whereas the LLC is a little looser. We can kind of pick and choose what formalities we're going to observe, as long as we have enough formality to the company. And enough formality that's, I can't tell you kind of what the bar is for that, right? I just know it when I see it. But anyways, hopefully that answers that question.
Got two more questions here, Peter. So someone asks about meetings and meeting minutes for a single member LLC.
Right. Yeah, it does seem very silly to sit down and meet with yourself and resolve actions kind of when it is just you. That said, the best practice is to go ahead and create those meeting minutes. I have a structure of LLCs myself. I just got married. I haven't bothered to add my wife onto the LLCs yet. So it's a single member LLC structure, about 4 companies all linked together. And yeah, I have documented single member LLC minutes where I talk about the member making sure that there's a quorum present. Now, granted, I do these very formally. You may not do them quite as formally. Document that there's a quorum present because I'm present. I talk about the issues. I resolve actions. Again, it seems very silly, but I really like the idea of being able to walk into the courtroom and say, here's 10 years of company minutes, right? I think that looks really good. That's the kind of formality that we're looking for, single member LLC or not. And I think the argument is, with that Ashley Albright case out there, the more formality you can run a single member LLC with, the better the arguments are going to be in your favor, because you have an argument to make, right? If you have that Albright case out there and then you have no formality to your single member LLC, you're kind of getting done on 2 different fronts there, right? And so I would be concerned about the asset protection that LLC may gain.
All right, and we got another one that I'll let you decide if this is a little too specific for one individual's case or not, but here is their question. I have 5 LLCs with 1 Wyoming LLC managing the other LLCs. And once I got funding from SBA, I had to change my LLCs from 3 members to just me. I feel like I lost asset protection by doing this. Do you recommend me setting up a trust, giving me more protection, or a corporation?
Yeah, that's a really great question. Certainly not too specific, but I can tell you this webinar, depending here, it may run long. I wasn't going to talk a whole lot about trusts. I don't like trusts, just so you know. I like them for estate planning purposes. Legitimate estate planning goals, we can absolutely accomplish using a trust. Asset protection, you're not going to get the asset protection out of a trust that I think a lot of promoters will tell you, and maybe what otherwise you might think. The reason is because there's two different kinds of trust. There's an irrevocable trust and a revocable trust. If it's a revocable trust and you get into an asset protection argument, the judge just says it's a revocable trust, just revoke it. Why are we here? Right. And so in that case, I would say that a trust is almost even less protected than an LLC. Now, you could make it an irrevocable trust, but if you make it an irrevocable trust, you're going to have to give up some of the benefit or control of the asset, and that kind of defeats the purpose. I wouldn't necessarily set up a corporation either for tax reasons, because based on the activity that you're doing in the company, corporation is probably not going to be my first choice. So I might consider making another LLC the member. I might consider trying to pull on additional members. I'm not sure why you had to let those two leave. It must have been a term of the SBA loan or something. If it was a term of the SBA loan, though, adding a trust or a corporation probably is going to be an equal violation of the terms of that loan. So, hopefully that gave a little bit to consider there, but I don't know, maybe we should talk more about that in the Q&A. I think
fair enough.
I just said no, none of those ideas, and now I want to move on. So I don't know how helpful that really was.
Got another question. What are the means through which interest in an LLC can be discovered in the case of the reverse piercing? Specifically, if the LLC has a registered agent, so on the state filing, the name does not appear. For example, real estate investors are beneficiaries in the property policy discoverable.
Mm-hmm. Well, yeah, that's a very good question. I mean, my firm, for instance, we act as registered agent for a lot of companies. We do it for an additional fee when we set up an LLC, but basically, if you do that, if you hire us, we will list our office address as your principal office address. We ask that you get a PO box so the mail goes directly to you. But then we sign the filing and everything so that when you search the company on the Secretary of State website, nothing points back to you, right? Everything points back to a law firm, specifically me and my law firm. And then the idea is that people can't, in the public record, figure out that you own the company. Now, that said, I think it acts, having a commercial registered agent where you remain anonymous, that acts, I think, as a barrier or a hurdle to starting the lawsuit, because they have to decide if it's even worth going for the free consultation with an attorney, right? Is it even worth getting an attorney involved, paying the hourly rate, whatever it may be? If they can't figure out who owns the company and they can't figure out if you have deep pockets, they may say that hiring the attorney is too much work, right? That it's not worth it and just move on. That's at least the thought process. Now, if they are hurt enough or dedicated enough or whatever to go ahead and go to the attorney and file the paperwork and get the case started, then we have everything going on with a lawsuit, a civil case, and part of that is going to be discovery, like the person who asked the question mentioned. And so discovery is a heck of a process. But you answer these, there's going to be interrogatories, and interrogatories basically are questions from the other side that you have to answer, and you answer those questions under penalty of perjury, and you answer those questions potentially, you could be in contempt of court if you don't answer correctly, honestly, whatever. So if they ask, and they will ask, okay, who owns the LLC? Can I see the operating agreement? Or provide a copy of the operating agreement, provide a copy of all company minutes, right? What else do the owners own? Are there any other investment properties? Are there any other LLCs, right? And so as we begin to come down all of those questions, you're going to have to answer those truthfully, potentially on pain of being held in contempt of court and perjury, right? So I think the commercial registered agent is a useful barrier or hurdle early in the process, but if you get to the point where you are being sued and you have to go through the process of discovery, I don't know how much help it's really going to be because we're going to have to answer those interrogatories anyways, right? So hopefully that answers that question. If there's more, absolutely let me know.
Yeah, so one more real quick. What do you charge to be a registered agent?
It depends on basically how many companies we're looking at doing. If we're only doing one, it's $125 annually. This being recorded, if you come and watch this and it's 2 years later or something, don't hold me to this price because it probably will index with inflation, right? But $125 annually for one company. If you set up multiple companies, we actually discount it down 50%, and so it'd be $62.50 annually per company.
Gotcha. And so one last question, I think, for the moment. Can one plead the fifth during interrogations?
Yeah, the Fifth Amendment right against self-incrimination is a constitutional right. You can always bring that up. I don't believe it would be proper in that case, though, because it's a privilege against self-incrimination. And so owning a rental property is not a crime, right? If the Fifth Amendment is there to basically say, it's like if you were going to answer a question under oath, but it would show that you had robbed the convenience store around the corner, you could invoke your Fifth Amendment privilege because it's going to incriminate you, right? Owning a rental property, on the other hand, is not a crime. So you wouldn't really have any grounds to invoke that right in that case.
Got another question, but we're also starting to run out of time. So, Peter, do you want to save some questions for Q&A, or there's some highlights you want to get through in the next 15 minutes, 20 minutes or so, or do you want to keep going with these questions?
Why don't I try to actually talk a little bit about some tax changes? And then we'll see about the questions here. So this slide here, by the way, is just to show you my recommended structuring for potentially what we might do. Now, granted, we have a triage we have to go through, but we have rentals on the left here. Typically, I set up kind of a parent company, some subsidiary companies there. And then, on the other side, fix and flips, wholesaling, brokerage income. I look at setting up an LLC taxed as an S corporation, but I do keep those activities separate. And the reason is because the type of taxation is so different. The strategy for taxes need to be so much different. I'm going to skip over that common mistakes only because of time. Where, somebody mentioned Wyoming. Just so you know, there are these different kind of havens, Nevada, Wyoming, Delaware, traditionally very business friendly. Unless your property is located in one of these states, you really are not going to receive the benefit of the law of the forum where you've gone. They call this forum shopping. Here's the thing. If you have a rental property in Colorado and you live in Colorado, your property's in Colorado, your tenant's in Colorado, the harm is in Colorado, a Colorado court is not going to apply Wyoming law just because you registered in Wyoming. Right? Because there's so much tied to Colorado, particularly that the property and the harm both happened here, they're going to apply Colorado law. So, Nevada in particular is expensive. If you're paying Secretary of State fees year after year after year and all your properties are here in Colorado, you might consider unwinding that structure and pulling it over into Colorado because in my opinion, it's good money after bad there. Okay, so this is one of the new changes in the tax law. It's probably the biggest change and probably what will have the biggest impact on taxpayers in the real estate context, particularly, although there are some limitations. But when they were talking about the tax changes, you may remember that there was one of the really big selling points of the new tax changes was that the top corporate rate was going to be cut from 35% down to 21%. That's really helpful for big, like publicly traded companies because typically they are C corporations, which is what that corporate rate was meant to address. But what's interesting is that we also have flow-through entities, and flow-through entities are not C corporations. They're S corporations, partnerships, disregarded entities, et cetera. And so they snuck in a similar provision at the very last minute to make these flow-through entities also competitive, and that's the 199A deduction. So the 199A deduction applies to all these flow-through entities, right? I'm going to give you the very oversimplified version. I would love to show you a flow chart that I created. When I give a presentation like this in person, I actually pass out the flow chart so you can see how complicated this law is. So I'm giving you the extra super oversimplified version of this. But basically what you do to figure out your 199A deduction is you look at how much qualified business income you have. Qualified business income is a new term in the tax code. It's not used anywhere else, it's not calculated anywhere else, and so we have to define it, right? So qualified business income is not wages or salary, it's not short-term capital gain, it's not long-term capital gain, it's not dividend income, and it's not interest income, okay? That, I think, is what most people earn, and what most people who work like a W-2 job, they're probably falling under that category. What 199A does include is 1099 income. So if you're an independent contractor, you're going to really benefit from this. K1 income, and the K1 income is relevant for pass-through entities because their tax returns generate these K1 schedules, and then rental income as well. And so rents should qualify under this. I say should because it's not specifically said in the code that rent is included. But if you look at the congressional history and the notes about what the congressmen actually were talking about, rental income is included in the congressional history. And so the position of all, I shouldn't say all, but the by and large, the consensus among people in my profession is that rental income is going to be included. So basically you calculate how much qualified business income you have, and then you're going to deduct 20% off the top of that. But it's not quite that easy. There are income limitations. If you make over $315,000 as a married couple or $157,500 as a single individual, you're partially going to be phased out, and the amount that you're phased out is going to increase as you begin to bump up against these other numbers, $415,000 for married filing joint taxpayers or $207,500 for single taxpayers. At that point, you are fully phased out, so you're not going to benefit from this 199A deduction. There are also special rules for what's called a specified trade or service business. And what are we talking about here? We're talking about health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services. But this is the gotcha. This is the catch-all. Any business where the principal asset of such trade or business is the reputation or skill of one or more of its employees or owners, right? And so if you look at this, what's interesting is that architects were left out, engineers were left out, and traditionally, when we talk about these specified trade or service businesses, those individuals are actually included in the definition, and so they specifically were left out. Real estate brokers, real estate agents, we may have some of those on the call. What's interesting is, maybe under brokerage services you guys are included, although my understanding of the congressional history is that that's actually more like stock brokerage. So real estate agents, I believe, don't necessarily fall into this category unless you're very successful and you get a lot of referrals, because then your trade or business, the principal asset is going to be your reputation and skill, right? That's why you're getting all of these referrals. So you might be clawed back in to these special rules. Now, even if you're in these specified trade or businesses, if you make under 315 or 157.5, you still qualify, but there are special rules that are going to apply if you make over those threshold figures. So that's a really long way to say you're going to have to work with me, my firm, your CPA, whoever on this new 199A deduction if you have this qualified business income, because potentially that 20% deduction is huge. It's going to be a big boon. And when they talk about, the potential for this to put a lot of money back into your pocket, to me, the 199A deduction is one of the biggest ways that they're going to do that. And so you really want to maximize on that 199A deduction. Should be pretty simple if you're under those income limits, but if you're over those income limits, you're really going to need specialized help to make sure that we're doing everything that we can.
And so got a quick question on that.
Yeah.
Would business consultant be included in that list?
Business consulting?
correct?
Yes, I believe that it would, and the reason is because it's health, law, accounting, actuarial science, performing arts, consulting. And so I think consulting, unfortunately, is a very broad category, but it's not like law where, okay, it's pretty straightforward if you're a lawyer, or health, doctor or whatever. But consulting can be quite a large umbrella term, but I think you're going to be clawed in under that provision. At least that's what the IRS would argue, right? You could take the position that somehow you're exempted, but I think considering that the word consulting is in the code, it's going to be an uphill battle.
And then one more on that. They ask, are movie industry 1099 folks included?
Movie industry. I have not been asked that one yet. I love it. You're not in any of the specified categories there. And so then you're looking at, well, is the principal asset the reputation or skill of one or more of the employees or owners? And so if the company, I guess it kind of depends on if you're a production company, if you're the talent, you're an actor, whatever it may be. Now, if you're an actor or an actress, you're probably going to be clawed back into this because the reputation or skill of that individual is really what makes the people want to hire you, right? If, on the other hand, you're a production company, it might depend, right? And that's the problem with this definition, is that it's very case by case, right? If we're talking about, say, industrial light and magic, probably you're going to be clawed into this because industrial light and magic, it's the reputation and skill that they're coming to you for, right? Industrial light and magic's a huge name in the movie making industry. If, on the other hand, you're a smaller company or maybe just starting out or less renowned or whatever, then maybe you could qualify for this, and I think that you would. It's just going to be, again, case by case. You'll take the position, and then if you're audited, the IRS may agree with you or they may take the opposite position, and then the legal arguments need to be crafted. What's really fascinating about this time is that, like I was saying, the code by and large was written in 1986, and we've had years of tax court cases, treasury regulations, revenue rulings, all kinds of great stuff to interpret what the law actually says. We've had since 1986 to have all that develop. In this case, with 199A, we have the code, just the words found in the code, and then we also have, like, as of last month, treasury regulations, and they're temporary treasury regulations, but we at least have something, and that's it. That's all we have to interpret this, right? And so what we need is that body of case law where courts and judges actually look at this and start actually drawing the lines of where this applies and when it doesn't, and who it applies to and who it doesn't apply to. It's going to be fun to see it unwind a little bit so that we actually see how it plays out. But again, then we're back to the test cases, right? And we just have to decide if it's worth, and we have enough of kind of a standing and a legal argument to really back it up if and when you are challenged, because we may not have a whole lot to point to say this is a similar case and it's a slam dunk, right? So hopefully that makes sense. I have 4 minutes or maybe even less. I think my watch was running slow, so I probably have even less to talk about self-employment tax strategies. Just to give you a real high-level thing here, S corporations are the way to plan around self-employment tax. The reason is because there's two different ways that you pay yourself. You pay yourself with a reasonable salary, and you pay yourself with a shareholder distribution. The salary has self-employment tax levied on it, and the shareholder distribution does not. And so when you actually run the numbers, you can see that an S corporation on $100,000 of net income, if you just do a 50-50 split, and we can talk more about that, or the wisdom of doing that, the S corporation is going to save you around $7,500. And that's not even taking into account the new 199A deduction, which is actually going to save you even more, right? And so if you're self-employed and you make, I would say, over a certain amount of money, because you are going to have to deal with a payroll company and there's some headache and extra time that goes into that, potentially just filing the paperwork to become an S corporation could save you quite a bit of money. And so that's something you should consider as well. The tax law changes did not change this. This is still completely a valid planning point and a planning tool and something that everybody should consider if they are self-employed. But what the tax law did in addition to now is add in that 199A deduction to make the savings even greater. Okay, so I'm going to skip over the acceleration of passive loss recognition. There I was really just going to talk about real estate professional status and kind of the wisdom of doing that. But that really is independent of the tax law changes, so I'm not necessarily going to talk a lot about that. What I will say really quick is, we now offer a new service called tax coaching. And what tax coaching is essentially, if I was doing this presentation in person, I would just ask the question, when was the last time your tax preparer actually sat down and said, hey, I have an idea to save you money on your taxes, right? For a lot of people, I think the experience of tax preparation looks like a revolving door. And it's not so much actual coaching, actual identification of opportunity to save money. And that's really what we're trying to develop. And we have brand new services rolled out to actually implement this idea of tax coaching, where we actually interact with you, come up with ideas to save money on taxes, actually lessen your tax bill, and less of that data entry revolving door kind of feel. So if you're interested in that, certainly give my office a ring. And Justin, I think we're butting up against the time limit here, but if we can answer questions, I'm more than happy to stay and do that.
Awesome. Great. Yeah, we definitely have some questions. Let's go back up here. All right. If I have separate LLCs for each property, can I have them all managed by one LLC management company and therefore not have to do individual tax returns for each LLC?
That's a really great question, and I'm actually going to pop back to one of my slides here, because that's exactly what I recommend in this structure. And I don't know if you can see my mouse, but the structure over on the left. What I recommend for rentals in particular, now we can do a variation of this for the S corporation, the fix and flips and all of that. But what I recommend on the rental side in particular is that you set up single member LLCs, and those are going to be disregarded entities, and they're 100% owned. The single member of that single member LLC is a multi-member LLC, which is what I'm showing there on the top. I'm going to have that company file a Form 1065, a partnership return, because that's the best tax treatment for rental income. But what that does is it puts your properties in different baskets, right? Because they're in those different single member LLCs. And then the whole structure, because every single member, every LLC is a single member LLC, a disregarded entity, everything flows up to that partnership LLC. And so I have one tax return for the entire structure. We could have 15, we could have 20 companies, going on in that structure, but if they all flow up to that master multi-member LLC, one tax return. I think a lot of CPAs, and I'm not necessarily pointing fingers, but I think a lot of CPAs don't necessarily grasp this. I've seen a lot of structures, and I've dismantled a lot of structures where we just have the disregarded entities, but what they are is actually partnerships. So if we had 15 companies, they'd file 15 tax returns, right? And that's going to get very costly come tax time. So that's a really great question. But my structure, I think, walks the line between good asset protection and then only one tax return to be streamlined come tax time. Now, it does kind of beg a question, and Justin, I'm sorry, I'm getting so worried and I'm getting so carried away here. I don't know what I was trying to say there, but carried away here. But the multi-member those single-member LLCs, I just said, well, wait, single-member LLCs have this problem in Colorado, right? We have this bankruptcy ruling. Maybe they're not the best. The difference between the structure I'm recommending here versus just having a single member LLC is that if for any reason a creditor is able to pierce through that single member LLC, they're just rolling back to a multi-member LLC, which is going to be very difficult to pierce for asset protection reasons, right? And so there's a layer there that otherwise wouldn't be there that makes you a little more protected than a single member LLC just by itself. So hopefully I kind of thought ahead to some questions that may come in and answered that one.
Gotcha. So here's something along the same lines. I have 5 rentals, and setting up 6 LLCs, the 5 property LLCs and 1 parent LLC, is expensive. If you create one LLC for all the rentals, down the road, can I break them out and create the additional 5 property LLC, 5 property, LLCs?
Yeah, that's a really great question too. Um, a lot of my clients do struggle with kind of the cost versus the benefit, and how much do they really want to go down the road, and et cetera, right? If you ever work with me, you'll know that a lot of times I can never really give just one answer, right? What I will give you a lot of times is, and I'll preface it and I'll say, look, this is the maximum asset protection answer. And then I give you, this is probably the more livable answer, right? And then you can decide how you want to move forward. The maximum asset protection answer, without a doubt, would be to create all of the LLCs and hold one property in each LLC, right? But yeah, it is expensive. And, at the end of the day, it goes back to your risk tolerance and how much are you willing to put into one LLC? Because if everything is titled in one LLC and one of your tenants hurts themselves, the potential for them to reach the equity in all of the remaining properties is very high, right? Because it's all titled in the same LLC. If you're comfortable with that, and it would be a bad day to lose all of that, but if you lose it, if you're comfortable with that because you wanted to save the time, energy, and cost of the initial setup, then by all means, that works, and it does set up a good LLC veil between your rental properties and your personal assets, right? Your retirement account, your personal residence, your car, whatever else, right? And so, in a way, it walks the line. But what you may consider in the interim would be setting up maybe 3 LLCs and at least getting a little more, break or a little more diversification, and get your eggs into at least a few different baskets, just in case the worst were to happen, right? And that may be a way to kind of walk the line there. Yeah.
Gotcha. And so what we're talking about here is a series LLC structure. Is that correct?
Um,
Or if
no,
not, how would you define that?
well, it's not correct. The reason is, it's a very similar concept. I think in spirit and in concept, it is essentially a series LLC. Colorado does not recognize series LLCs. Only a handful of states do. And so because of that, we don't set up series LLCs here in Colorado. I can't even recommend them. And so the structure that I create, the structure I'm recommending here, is essentially a series LLC, but it's how we do it here in Colorado because we can't set them up in Colorado, right? A word of warning about series LLCs, they're very new. And we don't have a whole lot of case law suggesting how they're going to hold up for asset protection purposes. My sense is, just kind of from afar, and this is me just kind of in the armchair, just projecting what I think is going to happen, is that they will receive asset protection. They'll work a lot like the structure that I'm recommending here. But until we really have that body of case law, I can't be certain, and you certainly shouldn't rely on that by any means. So I'm not going to go much more into series there. Hopefully that answers that question, but we can always talk more about it.
And how do land trusts fall into this type of a structure?
Yeah, great question. Again, I don't really like land trusts. I don't really like trusts for asset protection reasons or purposes. Really what you're doing when you have a rental or you have a fix and flip is you're engaging in a business activity, and you should have a business entity to use with that business activity. It's just matching the activity to the correct tool. A land trust, by definition, very kind of informal, which is not what we want for asset protection reasons. There's the revocable and irrevocable question. If it's revocable, there certainly isn't going to be a lot of asset protection associated with it. If it's irrevocable, you're going to have to give up some control and benefit of the asset, which you're probably not going to want to do if, on the other hand, we just created an LLC and you can have all the control and all the benefit. If you begin to go down the road of making the trust more formal, then we really would look to get its own EIN. It would probably need to file its own tax return. That's debatable, but if we go that far down the road of formality, then the trust tax rates are compressed compared to a flow-through entity, so I can't really recommend it from a tax planning level. So there's a lot of reasons I personally don't recommend a land trust, but one thing they are really useful for is anonymity. And so if you're not relying on it for its asset protection, then what I would do is I would create a master LLC like I have on the left there, but I would create it so that the owners of the master LLC were two different land trusts, right? Then you're getting a lot of anonymity, but it's a really complicated structure, and if you're looking to ever sign paperwork, or you're going to have to sign as a trustee representing the member of the partnership, or it's just going to get very confusing, and the chance for you to screw up some formalities is very much prevalent, and that's what we don't want for asset protection. And so I would recommend a simpler structure, and again, just pairing the correct tool to the business activity and using a business entity. I think that makes much more sense. You'll be much better served. And I think the fees and the time and effort that you pay you'll get more benefit out of it.
Gotcha. And so we do have a national audience, Peter. And so someone's asking, do you work with people in Minnesota, or are you open to working with folks across the country?
Depending on the matter, yes. There are some matters where I'm jurisdictionally limited, right? I'm only licensed here in Colorado. But for business entity formation, for IRS work, for tax preparation, we can talk. Estate planning or real estate, I would refer you to local counsel. So it kind of depends. But if you give my office a call, Jackie, who's our wonderful admin up front, she can get you sorted and figure out if we're a good fit.
Gotcha. And then so along those lines, what is the best way maybe to set up an LLC? Can someone do it by themselves? Should they get an attorney?
Well, it's it's a loaded question because, of course, I'm going to say you should hire an attorney, right? And I should really say, hopefully, you will hire me. But if you don't hire me, you should hire an attorney. And the reason is because the formalities are terribly important, right? And you want to make sure that the formalities are in place and in place correctly at the very beginning. What I have with a lot of my clients, and I'm actually going to switch the slide here to this slide, because what I've seen with a lot of clients is they will set it up, and basically they'll file the paperwork with the Secretary of State and then just not do anything else. And I call that kind of the set it and forget it mentality, because really they just kind of disappear and don't do much else. They say that they're going to draft an operating agreement. They'll do it next week. They'll do it next weekend, the weekend after that, and it just never happens, right? You never have your meetings. You never, right? You just, there's no accountability to follow through. And even if you follow through, you can't be sure that you're following through correctly. And of course, everybody knows how great forms are that we find on the internet. There are some really great forms. On the other hand, there are forms that are just drafted by somebody in their mom's basement who has no qualifications or any idea what they're doing, right? And so is one form particularly better than another, or what you need? It's very difficult to tell. So, again, I would work with somebody, and the advantage of working with somebody like me is I do it all on a flat fee, and then I include a year of my time to consult on the next step questions, right? And kind of answer questions about what did I set up and what's in the operating agreement. If I'm looking at doing this kind of transaction, how does the operating agreement treat that? What kind of formality should I have to go along with that? For the first year, I consult on those questions. Just, it's not on my hourly rate. So you can shoot me an email, give me a call. We can sit down at the conference room table. That's kind of built into the price of the package, because I want you to get off on the right foot at the very beginning and not, charge you like 2 or 3 years down the road and charge you a lot because everything is just really screwed up and we have to unwind a lot of things, right? So hopefully that answers that question. It's a little loaded because I'm definitely going to say hire an attorney, but that's
Yeah,
that.
yeah, I kind of figured that would be your answer, but I appreciate you going into that. So a couple more here. Is there a way to deduct interest on HELOCs under the new law when the HELOC is used solely for business activities?
Yeah, it's a great question. HELOC, all of the laws changed with regard to HELOCs, and basically, if it's on your primary residence, the HELOC needs to be used to make significant improvements to that residence. You can no longer do the old planning tip of like pulling out a HELOC and paying off your credit cards or paying for some education or something like that. That's no longer deductible. It has to be a significant improvement to the property. Now, if you have a rental property and you pull a HELOC out on the rental property and you improve the rental property, or even if you use it as a down payment on a new property, I view that as deductible. That's business purpose, business interest, all of that. And so I would certainly say that that's deductible. What's not terribly clear to me, and what I would like to see some guidance from the IRS and the Treasury Department, is whether you can use a HELOC on your personal residence to buy your first investment property. The change kind of from the personal to the business there's not a whole lot of guidance on that. I think there's an argument to be made that that would be deductible, but whether that would actually hold up, we have yet to see, and we don't really have any guidance on it. So I think if you're in the position where you're looking at taking out a HELOC on a rental, an existing rental, and doing something with that, I think that's fine. If you're looking at doing a HELOC on the personal residence and making improvements, I think that's fine. Switching from personal residence to investment, it's a gray area at the moment.
Perfect. Okay. So going back to a question that was posed near the beginning. So without diving into cost segregation and stuff, can people expense capital improvements that are currently on scheduled depreciation?
So there's expanded. I need some water. There's expanded deductibility, immediate deductibility under Section 179. And with bonus depreciation now, there is actually a greater chance to speed things up and deduct things currently. That said, there are specific items that fall into the category of what can be expensed. And so if you're looking at doing this, I'm going to recommend that you talk to your CPA, you talk to us, and see if there's an opportunity to speed that up. I'm not going to get much more in depth than that at the moment, only because really those kind of changes, I could do an entire presentation just on the new accelerated depreciation of 179 items. It's involved, but there are big changes and there's a lot of opportunity there. So basically, and the rule of thumb for speeding that up is just basically, it can't be like structural and it can't be the walls, right? If on the other hand, it's, for instance, like HVAC, plumbing, plumbing's probably a bad example, but HVAC, something along those lines, then I think we're talking about the potential to speed that up. So work with the tax professional, look at it, look at the new code provision, and go from there.
Gotcha. So not a hard no.
Not a hard no. Justin, and anybody else who's seen me before, that I hardly ever give a hard no or a hard yes. I really love the maybes, and I love kind of the gray areas and showing you examples to show what's allowed and what's not allowed. So.
Perfect. And so going back to the formalities, got a couple questions around this. If they have not kept up their formalities with their entities, or maybe they had somebody helping them with their formalities and then that person retired and now that has lapsed, what does it look like to get caught back up? Can they just start today? Do they need to go back historically and do that? Can they go back historically and do that? What does that look like?
It's a very good question. And, I do a couple different things. I tried to roll out kind of a new service, and it was popular for a little bit and then it really died off, but it was kind of like a business entity health check. It's kind of like, okay, you go into your doctor annually and kind of get an idea of where you're at. Let's do the same thing with your business entities, right? And not necessarily annually, but occasionally I think it helps to have somebody with fresh eyes come in and just kind of say, where are you at and where do you need to be, right? When I would advise clients who had fallen behind on their asset protection, I would give them two different pieces of advice. The first is that, it's probably not the best strategy to like backdate some compliance documents, right? Because there's something just kind of, I don't know, I wouldn't say wrong, I wouldn't say unethical, but there's something about backdating documents that didn't exist, that probably wouldn't exist, that just doesn't quite sit right, right? Hopefully people agree with me on that. On the other hand, if you don't have the documents, yeah, formality could be an issue, right? And so maybe you need to weigh that. So my recommendation was, look, just draw a line in the sand, right? And say, okay, from, September of 2018 moving forward, this entity is going to be in compliance. I'm going to observe my formalities, right? In the short term, you may have a problem with your formality, right? If you get sued in the next 3 years or something, you're only going to walk in there with 3 sets of annual minutes. And if there's commingling in the history and, whatever, there's only 3 years of kind of clean bank accounts where it's not commingled and, whatever. That may pose a bit of a problem. It's not insurmountable, but it may pose a problem. On the other hand, if you run 10 years clean and there's a history of kind of non-compliance, but it was 10 years ago, that's probably not as fatal as, say, 1 year, 2 years, 3 years, right? And so in a way, it's kind of a sliding scale. And I think that the longer the company runs in compliance, the less of a worry that it is. So hopefully that kind of answers that question. I mean, I would recommend probably the line in the sand method rather than going back and trying to recreate stuff and backdating it.
Gotcha. And then so you kind of had mentioned commingling and that type of a stuff when it comes to incomes and expenses. If you have separate LLCs for each rental, do you also need to keep all the income and expenses separate, or can the parent company handle all the expenses and income for the rentals?
I'm chuckling to myself because there's a bit of a difference of opinion in my profession, and there's even a bit of a difference of opinion here in the office, even about maybe the best way to do this. What I do is I kind of give you two options, and I'm tired of Ron, what's his name, Ron Popeil or whatever. I'm tired of him looking at me. I'm going to switch this up real quick. But there's two kind of schools of thought about this. The first school of thought would say that you could use that master LLC kind of like a management company, right? And it being the management company, everything can kind of be paid to that LLC's bank account. The expenses can be paid out. There's obviously inherent kind of advantages of that because you're only carrying around one debit card, one checkbook, right? And everything in a way is easier because it's just in that bank account. Of course, my answer there, or my observation is, well, your business assets and your business income and expenses and all of that are commingled in that one account. And so I think the argument of a tenant in one of the sub LLCs to potentially reach over to the equity in another property in another sub LLC is probably easier because there's commingling in amongst that master LLC, right? It's still, I think, a hard argument to pierce through and get to your personal assets because you're not commingling with your personal assets. So I think the business is commingled, but it's not commingled with your personal. So in a way, it's kind of the medium ground. So, I mean, the maximum, this is me again telling you the maximum asset protection answer and then telling you kind of the more livable answer. Maximum asset protection answer would be to keep everything separate in its own bank account associated with the property. And in a way, that actually makes your bookkeeping easier because if you see income or expense in that bank account, you know what property it's associated with, right? And then it's harder for people to kind of reach over to equity and other properties because things aren't commingled. But on the other hand, you're carrying around 5 checkbooks, 5 debit cards. That can get a little difficult to manage. I recognize that. So again, I think it comes back to your risk tolerance and kind of how you want to approach it. I think there's two very valid separate approaches there, but one's a little stronger than the other.
Fair enough. Just a couple questions left if you got a few more minutes, Peter.
Of course, yeah.
All right. So if one takes a property from a family partnership LLC and puts it into a new single member LLC, is that a taxable event?
I'm hesitating. I'm hesitating only because I think there is some very pointed questions to ask. Is there, I guess, who would be the members of the family limited partnership would be my starting point. Because if there's multiple members of the family limited partnership, I think it could be a taxable event because there's potential ownership interest in the asset of other individuals involved, and we kind of have to address how the ownership then comes over. Probably the most likely would be, say, a gift or something like that. That doesn't necessarily mean that there's a tax impact if it's a gift, because we could file a gift tax return, we could shelter it using the unified credit. But that's something I think I would consider. And then the other thing I'd consider would be, I guess, two other things. The first thing I'd consider would be how much, even if there is a taxable event, is it livable, right? Maybe we just trigger the tax and move it. There's a problem with that because I guess you'd have phantom income. You'd have to come up with the money for the tax bill another way if you weren't planning on selling the asset, which it sounds like you're not. So there's that. And then the other issue I suppose I see with it would be that then you're putting it into a single member LLC, which probably has less asset protection than the family limited partnership. And so, that might not make sense even from an asset protection perspective. So I don't know. I've given some of the thoughts there from a 10,000 foot perspective, but it sounds like probably would have to dig a little bit more to figure out if it really made sense or not.
Yeah. Okay. Well, yeah, exactly. And so your contact info is there, so that would be perfect. Just followed up directly with Peter. Maybe dive a little deeper on that one. Another question. If we were to pay off a mortgage on a property, do you recommend lending yourself some money and recording a new deed of trust on that property?
Yeah, it's a fair question. They call that equity stripping, right? So if you have significant equity in an asset, basically you try to strip out that equity so that it looks less appealing as a potential recovery on a judgment or something like that. I mean, in this particular instance, I don't know how far that really gets you. And part of that, in a way, goes back to the thinking of the bankruptcy judge in the Albright case. And the tax court, for instance, has another doctrine, and that's not to say that it would apply in like a personal injury case, but it's something that sticks and speaks very truly to me. It's called substance over form, right? And so basically it's like, what is the substance of the transaction? What is the form of the transaction? It's kind of like if the form is like you being cute and trying to structure around the laws to avoid some kind of tax or something like that, they're going to cut through that form and they're going to get to the substance of the transaction and say, well, is there actually any kind of economic substance here, right? That's not, and again, so that I think is a very informative thing, because a lot of judges, what they do is they kind of look at the equities in the case and then try to find the law that's going to allow them to do what they think is justice in the case, right? And so that's a really long way to say, look, if you have somebody who's suing you, and say they're suing you for $1 million, right? And you happen to have a property worth $1 million, but you personally, it's held in an LLC, but you personally have a mortgage on that for $500,000. The judge might look at that and say, why does this mortgage even exist, right? I mean, it's you own the property, you own it through this LLC, it loaned you money. It's making payments to you, but just forgive the note, right? Let's make this person whole. I guess I just don't know how far that really gets you in that instance. So it's not to say that it wouldn't be held up. There could be legitimate reasons that you would do this, but I would document it. I'd come up with as many legitimate reasons as you possibly could, document all of those, and then show that the loan is negotiated kind of at an arm's length deal. and that the interest is a fair interest rate, what you would get on the market otherwise. You're going to have to pick up that income in interest, which you otherwise wouldn't need to do, pay tax on it. So, there's some benefits, but also some drawbacks. And then I guess what I'm saying is even after you do all of that, I don't know how effective it's really going to be. I think that they're going to try to find a way to disallow that if they can. So hopefully that answers that one. That's a very good one. I haven't been asked that question, I think, ever, or at least in a very long time. So. Okay, well, maybe we are finished up here. I'm not sure.
Well, there you are. Sorry.
No, yeah.
Had you on mute for a second there. Got another one here. I'm an independent real estate broker. I have an S Corp, which was set up as a holding company, and an LLC, which is my real estate entity, and is a single member LLC owned by my S Corp. The structure was recommended by and initially set up by a company in Nevada, although I have since moved it all to my home state of Wisconsin. Would you recommend changing this setup?
I mean, if we were setting it up from scratch today, it is certainly not the structure that I would recommend. That said, it's not necessarily harming you year to year right now. When you say it's a holding company, I'm going to presume that it's holding rentals. If that's not the case, again, my contact information is up there. We can always hash out something else. I'm just going to presume that that's the case here. The problem with an S corporation and rentals is that you can't move the rentals out of the S corporation without triggering a tax event. So for instance, if you need to refinance the rental, you want to do a cash out refi, you want to pull a HELOC, whatever. If the lender looks at the property and says, we need to have that in your personal name to underwrite the loan, you're not going to be able to move that title into your personal name without triggering a tax impact. And the tax impact is basically like you sold the property, right? So if your basis in the property is $100,000, it's grown to $300,000. You have $200,000 of presumably capital gain. You're going to have to pay the tax bill as though you sold that property, and because you're not selling the property, you're going to have to come up with those funds from somewhere else. So that's kind of the problem with it, and because of that problem, I wouldn't really even recommend restructuring it because you're going to trigger those tax impacts if and when we move the properties out of the holding company, right? So if you did it like 3 months ago or something, and there really hasn't been any gain, then yeah, or any appreciation in the property, then yeah, that's something that we might look at. But on the other hand, if you did this 3 years ago or 10 years ago, even worse, I'm probably just going to recommend that you just keep them where they are and just until you sell the property, because otherwise we're going to trigger that tax impact.
All right, Peter, 2 more last questions.
Okay.
I hope that's it. I'm not gonna let any more in. But there's a ton of people still on and listening, so I really appreciate everybody for
I love it.
sticking around. Yeah, absolutely. So what should I be aware of if I purchase a property in my personal name and then immediately change title to an LLC?
Yeah, it's a really good question. You should be prepared for a few different things. The first is when you file with the Secretary of State, you're going to get a lot of junk mail. So I'd prepare for junk mail. That's kind of glib and tongue-in-cheek, but it is absolutely true. The bigger thing that you need to be aware of would be if you purchase the property with financing. I know a lot of hard money lenders, and I won't speak for Pine because I'm not sure, and maybe Justin, after I answer, you can talk about Pine's practice, but I know a lot of hard money lenders, they actually want you to close on the property in the LLC. And so if that's the case, if you close on the property in the LLC, and just from the start, it's always been titled in the LLC, you don't have a problem and we don't need to worry about this. If on the other hand, you close in your personal name, and this typically happens more with like traditional financing, FHA, VA, conventional loans, those kind of things. There's something called a due on sale, due on transfer clause. And basically when you transfer, so you close in your personal name and then you transfer to the LLC, that's technically a transfer that would be in violation of the promissory note between you and the bank, right? And so when that happens, it gives the bank ground to call the note due. And that basically just means they accelerate the time frame for you to repay them, and they say, pay us back immediately, right? Because you transferred, you violated the terms of the loan. In practice, we have hardly ever seen this actually happen. I used to be able to see that I had never seen it happen, but it did happen to one of my clients out of the blue about 8 months ago. So it's not unheard of. But the biggest thing I would say is that we're in an interest rate environment right now where things are really low. It's 3.5, 4%, whatever it may be. It's been a little while since I shopped the rates, but we're somewhere around in there. If things go to 8%, or something like that, then we could see a lot of these loans potentially called, right? Because the bank's just leaving money on the table by not forcing you to refinance at 8%, right? So there's that due on sale, due on transfer clause. That's probably the biggest thing that you need to think about, and something that you should be aware of.
Yeah, I agree. That's what we would see, generally speaking, as well. So Pine Financial specifically could lend to either an individual or to an entity. So we could work that either way. And so if you're looking at buying rental properties, generally those investors are looking to be getting a Fannie Mae, Freddie Mac, some sort of conventional financing for the long term on their rental property. So what they do, what I would recommend is buying the property in your personal name, which Pine Financial could finance, get the work done. And then when you're refinancing, that refinance would have to be in your personal name, because those conventional loans want to only lend you personally money, not to your entity. And then after you get through the refinance, then if your risk tolerance is such, then transfer title to your LLC or whatever entity you feel is best. But yeah, the big factor that I see in here is the due on sale clause. And I've seen and heard of it tripped twice. One time, somebody refinanced. So they paid off the bank and just refinanced the property. The other time, what they did was they transferred title back to their personal name, and that satisfied the bank. And then they waited 6-8 weeks and then transferred it back to their entity again. And so that worked for them. So that seems to be the big risk, is that due on sale clause. So as long as you're prepared for that, and you have a couple different strategies if and when that does happen, then you got to follow your gut and trust it as to what direction you should go for the best asset protection.
Yeah, I agree entirely with what you said there, Justin. And if you look at alternatives, right? I mean, what's the alternative? You then proceed with no asset protection, right? You should always layer. I had a slide about this. You should have your LLCs, you should have your insurance policy, whatever else. If you're not using the layer of the LLC, you're relying solely on insurance. And I don't want to offend anybody who may be in the insurance industry or anything like that, but those insurance policies are monsters to read and pick through and try to figure out. And frankly, I don't know that I'm always covered, right? And so to proceed only with insurance would make me very nervous personally. Now, again, it may be different for other people, but your alternatives are trigger the due on sale, do a transfer, potentially trigger the due on sale clause, refinance if necessary. I've seen that also where you just transfer the title back into your name. The bank doesn't seem to care too much about that right now, but if interest rates increase quite a bit, maybe that changes, I don't know. But the alternative is you're proceeding with no asset protection other than the insurance policy, and that would make me nervous. So I don't know, maybe that helps paint that too.
Yeah, I mean, it comes down to everybody's individual risk tolerances, right? Which most of this really does, right? Here's the options. Here's what we might recommend. Here's the way to best protect yourself. But then here's maybe what's more realistic. And then ultimately, you're there to advise them as an attorney. but it's up to them to decide really what direction they want to go and where their risk tolerance is.
Right, exactly.
All right, last question. Peter, I have a structure kind of similar to one that was mentioned earlier with the management company. I have separate LLCs that each own a property with a master LLC that owns the single member LLC. I have another LLC on the side that I run my real estate brokerage and property management through. This property management LLC then distributes profit to each property LLC as any management company would do. What do you think?
Yeah, I'm considering because that really is almost exactly what I have here. Now, I'm presuming you have them taxed this way. That may be up for debate. But no, I think that that's perfect. And I guess the only area that I might ask about would be two potential areas. One, is the management fee that the management company is charging the single member LLCs commercially reasonable, right? Is it what you would get if you hired a different management company? Because I think that these kind of transactions, again, going back to that substance over form kind of theory in the tax court, if you're going to do these kind of things, it needs to have some economic substance to it, right? There actually needs to be some substance and not just form. So as long as that's reasonable, I think you're doing it just right. There should be 1099s going as well, and so there's compliance things along the line, tax-wise, that you need to be sure that you're doing. But from 10,000 feet, I have no problem with this. The other question that I would ask, though, is why we're doing it. There could be a legitimate reason, which would be we want to show kind of some quote unquote active income, right? Some W-2 income, maybe to qualify for loans or those kind of things, in which case, yeah, this would be a really great way to do that, because through the management company that issues the 1099s that earns the fee, all of that, you're receiving kind of that active wage, presumably, assuming it's taxed the way that I have it here. But on the other hand, if you're not trying to do that, then I wouldn't even have the management company in the mix, because you're subjecting rent income to self-employment tax really for no reason. So it sounds like it could be a legitimate structure with legitimate reasons to do it. But on the other hand, if you're only doing it because you think there needs to be a fee paid for work that you do managing the rentals or something like that, we don't have to go that far. And maybe we could save you some money on taxes by not going that far. So it's kind of 10,000 foot, but if you have kind of some of those legitimate objectives, then I think it works. I wouldn't do much to change that.
Awesome. Well, Peter, thank you so much for your time and your expertise and your experience and sharing all this great information. Thank you to everyone who stuck around this long. If you have any other questions, definitely reach out to Peter. I work closely with him. Obviously, he's very knowledgeable. Definitely reach out to Peter, even if it's just to feel him out and see if you guys would be a good fit or not. Again, I'm Justin Cooper with Pine Financial Group. We are hard money lenders, and we'd love to talk to you about your real estate deals, being fix and flips, rental properties, new construction projects. Love to talk to you, just see what you're looking at and what you're seeing going on in the market. So feel free to reach out to us. Best place would be pinefinancialgroup.com. You can also find us on YouTube, where this video should be uploaded in the next couple of days, and Facebook. Feel free to like our page, both on YouTube and on Facebook. Like our page, subscribe. We've been putting out a ton of great content recently and would love to make sure all that gets in your hands. And if you're in Denver, don't forget the Real Estate Investor Success Summit coming up on October 20th. It's a Saturday. It's an all-day event. You can register at www.denveriss.com. Peter, thanks again for spending the night with us. Thank you to everyone, and we'll catch you next month.
All right, thank you, Justin. Thank you, everybody.